The most common problems I see people is, number one, they think that there's only one way to qualify because their bank basically said you got to pay yourself a certain amount of money and that is your only option. There's nothing in between. And in addition to that, they just don't even ask. They don't even look at all. So there's two things that you can do.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
Sometimes I can't believe that people miss these guidelines. They're so impactful when it comes to a mortgage qualification. I think the reality is well, they work with somebody who doesn't know, or they try to DIY it and they miss out on being able to qualify for a home or more money, or being able to actually use this to purchase a second rental property or an investment property. At the end of the day, if you are looking to apply for a mortgage, you need to know there are so many different ways to qualify, and different lenders have different variations of this, and it's going to impact you when it comes to potentially buying a property, refinancing or reinvesting or pulling money or buying an investment or whatever. If you want to know about the different things that you're probably missing right now, this video is for you. I'm going to break down the 5 things that I see that people get messed up on when it comes to their income all the time. Now, I don't want to make this like a typical listicle video. I'm not just going to do regular countdown, sort of, but what I do want to do is take the time to spotlight things that people miss, all the time when it comes to their application. So if you stay to the end, I'm going to give you not just that, but some juice that will help you. Let's get right into it, right off the bat. Let's talk about number 1, which is your job. If you're employed and you're getting a mortgage, it's hard enough to get a mortgage when you're employed making money in Canada anyways. What if you're starting a brand new job? The biggest thing I hear from people all the time when it comes to qualifying for a mortgage is, number 1, is that I need to be in my job for a year or 2 years or 6 months or 90 days. I hear all these arbitrary terms and numbers, and I don't know where this comes from other than just a myth or a rumor, or you're playing the whisper game where people whisper the same thing to each other. But the truth of the matter is there's not one set in stone guideline. Yes, there are different rules that are in place to try and make sure that people are qualified and have had their job, and if you're not skipping jobs every 2 months to a new company. But at the end of the day, if you're a qualified applicant otherwise, and you're taking on a new position in a salaried role or a guaranteed position role, and you've got some kind of proof of your history, or you're a professional, a lender is going to use your income contrary to popular belief. Some perfect examples of where this has come in is where someone is moving from a city to a new city, but they've already accepted a new position. They might be a professional in certain industries. They've accepted a new position. It's guaranteed. There are so many different ways that lenders will accept this, but it depends on the story and how you're doing it. So if you have a strong portfolio, strong credit, strong history of making payments in some way or another, then you're giving the lender a reason to be able to accept that consideration. Heck, I've even had people change jobs within an approval. I don't recommend this because this has also killed people's approvals, but I've had it happen where they let us know they like the opportunity to do this before closing. We were able to get a client approved prior to making the switch, and then after they were able to move their job before they closed. So that is probably number 1 biggest thing that I see people get screwed up on not understand. And the reality is changing jobs does not disqualify you. Lenders are just looking for continuity, industry experience, professionalism, and a good history. All right, number 2, let's get right into it. Number 2 is the exact opposite. If you're a business owner, you're self-employed, a contractor, anything like that, I could probably do an hour-long video just for business people. And in fact, I think I have done one earlier in the channel, but you need to know there's not just one way for you to qualify. Think about it this way. You've got corporations, corporate income. You have people who keep their money in their company, and they have for a number of years. You have dividends, salary, T4. We have people that switch from being a contractor to being a corporation and then paying themselves. In all these situations, the most common problems I see people is, number 1, they think that there's only one way to qualify because their bank basically said you got to pay yourself a certain amount of money and that is your only option. There's nothing in between. And in addition to that, they just don't even ask. They don't even look at all. So there's 2 things that you can do. Number 1, the reality is that lenders will, yes, they will use the 2 years of tax returns typically if it's a conventional bank, which is what we're talking about here today. But in some situations, they will actually increase that number by 5, 10, or 15%. In some situations, we can look at recency. And depending on what you do, and in fact, this is the case in doctors and medical fields, we can actually project out your income if you're self-employed and bypass some of the typical rules. Just remember this. If you're a business owner, you should be reaching out because there's so many variations. Number 3, okay, this is the biggest missed source of income that people don't think about. Child tax benefits. You have kids, you get paid by the government, guess what? That income is able to be used to help you in a mortgage application. Now, there's some age restrictions. If your kids are 16 or 17 years old, most lenders won't use that. But typically, if your kids are under 12, sometimes under 13, and in some cases even under 14, then a lender will actually use that child tax benefit, that income, to help you qualify. You won't believe how often I hear from people that they don't think they can use that income for qualification, so they don't even bring it up. So we ask for that upfront on every application. So think about your kids helping you to qualify. As long as that money is being directly deposited, you can show it on your CRA taxes, then you can use that money for your mortgage qualifications. Now, again, remember, this is only 3 of multiple different things. And I know this video is going to be focused on people who are trying to find different ways to qualify. So we'll go deeper on some of these other topics at a later time. But number 4 is a big one. And it's all about how debt impacts your mortgage qualification. So think of it this way. You have something called a debt to income qualification. And most people misunderstand what this means and how it works. If you have a car loan or a specific loan, then the lender will use the actual monthly payment that you're paying. But if you have a credit card or another unsecured debt, depending on the nature of that card, you typically have to show a monthly payment of 3% of the balance, which means a $10,000 credit card is a $300 monthly payment on your mortgage. A $10,000 secured line of credit, however, is totally different. So unsecured credit lines are typically 3% of the balance. Car loans and other loans are exactly what you pay. Student loans depend on if it's a repayment or not a repayment. And secured credit lines are a totally different beast. If you have a secured credit line, which is otherwise called a home equity line of credit, those can be qualified at a much lower monthly payment relative to how much you're borrowing. But you have to remember this. Some banks will use the entire amount of money that you have on your line of credit against you, and some banks will only use the amount of money that you're borrowing. Case in point, there's different ways to qualify debt, and the different lenders can actually impact what your options are. Okay, so the other big one that I hear where people get it confused all the time is actually rental income from appraisals. So let's say you're buying a house, and the house that you're purchasing has a basement suite. A lot of people say, well, I can't actually qualify to use a rental income because I don't have a lease agreement or there isn't someone in there right now. And some banks might ask you to do that, but there are lenders out there who will use something called an economic rental appraisal. And a rental appraisal, essentially what that does is an appraiser goes in, essentially determines what the market value is, whether it's 100% accurate or not. They give us a market value. And that lender can actually use a portion of that rental income, depending on the bank you use, 50%, 100%, sometimes less, sometimes more, to help you qualify. And that could be the difference between borrowing another $50,000 or $100,000 or even more on a mortgage qualification. Which brings us to the sub point, not just the fact that you can use a rental income from an appraisal on a rental suite, you can use that on a property you're moving out of so you can keep that property. But in addition to that, a sub point or bonus point is that different lenders calculate the amount of rental income in different ways. Some, if you're renting out a property, require you to have this claimed on your tax returns. In fact, most do. Some will let you use a market rent appraisal. Some will use 50% of the rent, while others will use the rent to offset the amount of money that you're borrowing, which basically, in effect, means that there could be a difference between if you're renting out a property for $1,500 and the mortgage payment is $2,000. On one hand, this could boost up your qualification by over $100,000. On the other hand, it could only offset around $20,000. So there's a significant difference in how much money that you could borrow based on all those parameters. So if you're confused at all about guidelines after this video, make sure to reach out so we can actually walk you through your situation. Guidelines not only change on a regular basis, they're different with every lender and different bank. And sometimes we amalgamate different lender options and different guidelines to help you qualify for what you're looking for.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.